and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast.
Hey, thanks for having me, Push. Always a pleasure.
Thank you, Paul, for taking the time to share your thoughts with us on topics that impact the world of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely benefits and barriers to the adoption of corporate real-time payments in the US, Swift's success in global trade interoperability trials, Singapore and China enhance digital finance and capital markets cooperation, and finally, BlackRock says world economy in new era of greater volatility. Our audience can read articles, interviews, and industry roundups by visiting ctmfile.com or by following the links in our show notes. Let's begin today's discussion with the first story, which is about the benefits and barriers to the adoption of corporate real-time payments in the US. On July 20th, 2023, the US made a leap forward with the launch of FedNow, the US Federal Reserve's real-time payment service. FedNow is not the first instant payment service in the US. The clearinghouse's real-time payment system, RTP, has been live since November 2017. The competition between RTP and FedNow is likely to intensify and will spur greater adoption of real-time payments in the US. In fact, as per the 2023 Real-Time Payment Survey report by the Association for Financial Professionals, sponsored by TCH, or the clearinghouse, 98% of organizations in the United States with annual revenue between $1 billion and $9.9 billion anticipate they will have adopted real-time payments within the next 5 years to send payments. Paul, from a corporate treasury perspective, what do you think are the primary benefits of using real-time payments, and can you also let us know what are some of the obstacles or barriers impeding the adoption of instant payment methods?
Yeah, sure, Push. I think about FedNow coming online in July of this year. I think it's a step forward to push organizations to consider the use of RTP. FedNow expands it so that all financial institutions have access to a platform to execute real-time payments. This is, a big step forward where the RTP platform and its members only account for about 60% of all the financial institutions. Now it's 100%. So now it allows organizations in areas that didn't have access to this technology to begin to consider it. So it's opened it up. And so I think one of the things I want to address first is probably some of the barriers, and then we can talk about the items as to why this is really a good thing for organizations in the long run. One of the big ones for a lot of financial institutions, and this isn't uncommon for any technology development or implementation of new technology within an organization, is getting it on the radar screen for your IT leaders to make it a priority. And this is always a challenge within organizations. And the survey points that out, that this is problematic for organizations, for companies, to get their IT folks to put attention towards it. So what that means is it requires companies to spend time socializing the beneficial aspects of using a platform like this, not ignoring the challenges, some of the other challenges that we'll talk about here in a few minutes. You can't ignore them. You have to address those kinds of concerns and demonstrate to your leadership why you can put belts and suspenders around the type of activity that occurs that will protect the organization. So there are things that I think companies got some work to do. I think in terms of the platform itself and issues around security risk, fraud in particular. With RTP, it's instantaneous, it's not reversible, and it makes it a big challenge for organizations to protect themselves against fraud. If something is let out the door, it's essentially gone at that point with RTP. And so that's the case with FedNow, or if people are utilizing the RTP platform, there's no difference in that respect. How do you mitigate that? Are there ways that they can ensure that when a payment is released, that it's being released to a party that they know, it's a known party? And there are things that organizations can do to take those steps to ensure that the payment's true and actual. And it's going to require the people that are executing those types of transactions to do the confirmation. So if you're doing the confirmation appropriately, you have a good payment information, then executing a payment through FedNow or through the RTP platform should make a difference from a fraud risk standpoint. You will have done your checks, your appropriate checks. This does require some effort on your Treasury team that's responsible for that. So you have to have a sound process that's in place. Some of the other things that I think is a barrier to engaging in FedNow and RTP is setup costs for engaging in the use of your technology to execute these kinds of transactions. So that's somewhat of a barrier. It came into play in this response. It was number 3 in the list, almost equal to fraud risk. So I think these are two things that organizations can put a belt and suspenders around to socialize the value of what you're going to get out of this. And so before I go to the value side, one of the other things that is a challenge or a barrier is the ability to batch payments through FedNow or RTP. You don't have that ability, so it's not like ACHs where you can batch everything together and deliver it. So that's somewhat of a challenge, but it's not necessarily a barrier that can't be overcome. So I think what we're going to see is that the technology is going to grow and there's going to be opportunities to effectuate a batch-like process in place. So when it comes to the benefits, I think these are the things that are getting organizations to come on board with the idea that, hey, over the next 1, 2, 3, 5 years, we need to be engaging in these types of transactions. We need to take a step forward to implement updates to our technology, our processes to be able to execute real-time payments. What they're going to find is that they're extremely low cost. So it's not like doing wires. It's a keen in terms of, relative to wires, it's much lower cost. Like ACHs are much lower cost, real-time payments are much lower cost. I think the low cost of the transactions help offset some of that upfront cost that you might have in getting the technology to function appropriately. The other piece is the strengthening of efficiency in payments. I think efficiency in payments and the ability to send and receive payments in real time helps organizations manage their cash better. Cash liquidity, capital management becomes more efficient through the use of platforms like this. So I think organizations are going to see that efficiency. The survey points out that being one of the top 2 risks or top 2 benefits for the use of platforms like this. The ability to manage cash flow. You can late date payments. You can instant bill. You get confirmation of your payments. And this happens in a very short period. So being able to do this, I think organizations are going to see the benefits are going to outweigh some of these challenges or roadblocks to using these platforms. I really do think organizations are going to take steps sooner than later to utilize or effectuate transactions across these platforms. And you're always going to have these various adopters, some that are going to adopt really quick, some that are going to sit on the sidelines, some that are going to dabble in a little bit to see how it actually works and is it doing what they expect it to do before they go all in. So I do see this as a trend for organizations. It just seems more and more when we think about writ large across the globe is going more and more towards electronic platforms to send and receive payments. That also means when you think about the currencies and how those are trading, we're heading towards electronic digital coins or tokenization for payments or the sending and receiving of value. Platforms like this, are set up to handle things like this. So I think this is just where the future's going.
This is where the future is going. Paul, I must commend you for your excellent analysis on real time payments. Let's move forward to our second story for today, which revolves around Swift's success in global trade interoperability trials. Swift has expanded its proof of concept on delivering an interoperability solution for different electronic bill of lading platforms. Earlier in the year, the first phase of the proof of concept saw Swift collaborate with EBL platforms eDocs Online and CargoX to test the use of a single API contract to open up a secure channel with Swift. The expanded proof of concept includes two additional EBL platform providers, TradeGo and WaveBL, and BNY Mellon and Deutsche Bank. Using the same API layer, participants could reproduce the end-to-end flow transfer process of an EBL in a simulated trade transaction. Paul, how do you think the Swift interoperability solution will benefit corporate treasury and or financial institutions?
Yeah, I think this is a really interesting proof of concept that's shown in this article. Think about trade finance or supply chain finance or the ability to effectuate a more efficient way to execute trade when it comes to supply. I think this is a step forward to making it way more efficient. We've talked about in the past the ability to have trade documents electronically, the ability to electronically effectuate financing for supply chain, for trade, supply. I think this is another step forward to be able to make that process more efficient, delivering through the use of blockchain platforms, such as the ones that they partnered with to effectuate this test that they did. So I think it is one of those things that we continue to see organizations out there reinventing the way things are done, partnering with each other. The collaboration across tech platforms is becoming more and more common because I think they realize that along the chain, front end to back end, there's benefits to collaborating. And so collaborating in this way and being able to come up with a new way of transacting makes it that much better for both parties or all parties involved. It can be a win-win-win, front end to back end. So supplier to the buyer, and then the trade platform in between where shipping is involved. When we think about efficiency of doing that and being able to lower your costs and the time to deliver, platforms like this can help do that. So this really is a good step forward. It will be really interesting to see how and when they might deploy this. I could see something like this hitting the market relatively soon and being able to be utilized across the globe. This is something that I think is really beneficial. One of the other things that was pointed out in this article, and people might be thinking about, compliance with regulators or standards within the supply chain, which is definitely important, as well as security. This article points out that the solution offers a way to manage those transactions so that you do have compliance, that you are following regulatory laws, and that you have a high level of security. So I think that was also another aspect that I think was important for what they were demonstrating with the POC here.
You're absolutely right. And with regulation coming under increased scrutiny, that is certainly an area to be extremely watchful of. Paul, your insights are truly on point. From Swift global trade interoperability trials, let's shift our conversation to digital finance and capital markets cooperation between Singapore and China. The Monetary Authority of Singapore has announced new digital finance and capital markets initiatives to expand its final cooperation with China. Three main initiatives have been announced. The first being a cross border digital yuan pilot between the two countries that will allow travelers from both countries to use China's central bank digital currency, the digital yuan, for tourism spending in Singapore and China. A further initiative is the launch of an exchange traded funds product linked between the Singapore Exchange and Shanghai Stock Exchange. Singapore's local banks and China's UnionPay International have also embarked on early stage feasibility discussions on a political remittance linkage between Singapore's PayNow and UnionPay under each jurisdiction's laws and regulations. Such a linkage could facilitate secure, convenient, and cost effective cross border payments and remittances between the two countries. Paul, as you know, Singapore serves as a business hub for Asia and is home to an array of large regional companies and multinationals, with some of the biggest companies in the world having set up their Asia Pacific headquarters in Singapore. China, on the other hand, is not only the world's second largest economy, but also the largest economy in Asia Pacific. Given your experience of the APAC region, how do you think this digital finance and capital markets cooperation between Singapore and China will impact or influence multinational corporations and their treasury departments?
Yeah, Push, I think I'll start with the latter two initiatives and then come back to the cross border trade with utilizing the yuan. I think it makes sense from the exchange traded fund standpoint. That seems like a logical step between China and Singapore to collaborate and share there. So I think from an ETF standpoint, that's not necessarily super surprising. I think that's something that, would have thought maybe they would have done sooner than later, actually. I'm a little surprised they haven't done that sooner, especially over the past 10, 15 years, how significant in terms of the use of ETFs, that's become pretty prevalent. Would have thought they would have hit on that maybe a little sooner, but definitely a good step forward from that perspective. Think about the other item in the latter part with the Pay Now and UnionPay. I think this is, in conjunction with the first item that was listed in the article, the cross-border payments. I think this is a step forward that will help effectuate what they want to have happen, and the ability to execute those kinds of transactions. As we know, with those platforms, being able to make payments that way is becoming more and more common in Asia. And so those two platforms are sizable and known, so it's known commodities. So the use of those platforms, I think, also makes sense, especially from China perspective. So this is something that I think China is looking to do as they continue to push forward with their initiatives that they have to become the world's number one economic power. These are steps that I think they're positioning themselves to do that, which brings me back to the cross-border payments utilizing the digital yuan. We know that China's rolling that out, that the use of digital coin, their currency is a digital payment. The acceptance of that in Asia, this really makes a lot of sense from China's perspective. And Singapore being a financial hub in APAC, they're the logical party to collaborate with, and to set up cross-border payments through there allows China to expand beyond just APAC down the road with the use of the digital yuan. So I think from China's perspective, this is huge for them. It may seem relatively smaller and insignificant on the outside, but I think down the road, this is really a really good partnership for them, because it's going to help effectuate some of the things that they want to do to take that next big step where their currency can be utilized versus using the US dollar when it comes to trade finance or the use of financing or leveraging capital on a global basis. So I think this just is showing that China is looking for those opportunities to collaborate and partner to expand their initiative. And these steps make sense.
Paul, you've given our listeners great food for thought. Moving on to the fourth story in today's discussion, wherein, according to BlackRock, the world's largest asset manager, the world is in a new era of low growth and high interest rates. In its outlook for 2024, the BlackRock Investment Institute warns that inflation will be far more volatile than it has been in recent years, and economies can no longer grow as quickly as they have in the past without stoking price rises. With the world economy entering a new era of volatility, investors need to switch off the autopilot and adopt more active management in their portfolios. Paul, you must have read that BlackRock has suggested three main focuses in 2024 for investors. As a seasoned corporate treasury advisor, Paul, do you concur with their investment outlook warning and the suggested three investment themes?
I tend to be a little more pessimistic than what some of the market is saying out there in terms of what's going on with the U.S. economy. So, I think their outlook aligns with my thought process, which is I do believe there's going to be a fair amount of volatility in 2024. We just had indication today come out with CPI that it's tampered down somewhat. I wouldn't hang my hat on that necessarily. I think we may see CPI stagnate in 2024. Maybe it dips down a little bit. There could be some ups and downs. It seems like to me, when we think about what's going on from a global footprint with the conflicts in Ukraine, in the Middle East, we've had disruptions out there that can have impact and add to volatility of energy. So energy has led the CPI down. So it's definitely has an impact, which people know. We know that as part of that metric. So the question is what's going to happen in 2024? I think there's definite risk that we could see movement in energy prices in 2024. I think when it comes to disinflation, beyond that, I think we need to see more happen before I think the Fed would act in terms of making those rate adjustments. I know the market's anticipating, there's several players in the market anticipating rate cuts in the first half of 2024. I'm leaning towards the back half of 2024. I just feel like there's more information we need to have. And I do think there's still a fair amount of uncertainty out there. And from a perspective of, being a treasurer out there, I need to be positioned to manage that appropriately, especially around interest rates and currency rates, what's going out there on the exchanges. So I expect that treasurers are still going to have a fair amount of hedging out there. So I expect the hedge ratios to remain elevated. And I think when it comes to making any kinds of brash decisions out there, I don't think treasurers should do anything that would be like a major move trying to anticipate something that may happen. I think they need to collectively monitor what's going on out there, make sure they have the right amount of protection in place to secure not only access to capital or funding, if they haven't done that, should have done that already, but being able to protect what you have in terms of the interest rates and the foreign currency and making sure you manage that effectively. So keeping an eye to what's going on out there, I think, is going to be really important. We start seeing consistency in things happening. That's going to help give treasurers more direction in terms of what's going to occur. But I think there'll definitely be some volatility out there across the board. So if I'm going to look at what's happening out there in the markets, the things I'm going to keep an eye on, I definitely want to see what's going on with inflation. I want to see what's going on with consumers, because we've had a lot of consumers from Black Friday, Cyber Monday, have done a lot of purchasing for the holidays, but they've done quite a bit of that with buy now, pay later, which gets me a little concerned about the ability to make those payments down the road. I think that there are consumers out there that are struggling today, that their rents are consuming more of their take-home pay. I believe that credit debt is gone up, especially if you're doing buy now, pay later. It's gone up. So the debt load and the ability to cover that, I think, is something we got to keep an eye to. We also got to keep an eye to what's going on with jobs. The whole purpose of the Fed raising the rates is to get the economy to slow down. So these things have to happen. We should see that unemployment rate, we're going to see that go up. We should see wages being tampered down. We should see, that there's less and less new jobs being created out there. And so these are things that I think as a treasurer, you just need to keep an eye on what's going on. As soon as consumers start failing, I think that's going to tell the tale of where we're going to be and what the Fed might start doing.
Finally, Paul, what is your choice for the biggest or most important story of the past week and why?
Yeah, I think, the one that stands out to me is the one we just kind of talked about regarding inflation. So, we're getting closer to a 3% level, still higher than what the Fed's target of 2% is. I think the big question is going to be, where is inflation going to go over the next 3 months, 6 months? I think the first half of next year, we will see some volatility across there, especially if we have other global impacts, disruptions that happen. So my eye is going to be on inflation and unemployment over the next 3 to 6 months. Those are the things I'm going to be watching. So it's the key economic indicators that I think are going to matter. So when are those rate cuts going to happen? That's going to be determined on what's going on from an economic standpoint. I don't think we can hang our hat on one thing, or that we get good news today. Hey, inflation's coming down. Great. Is that a trend? We don't know yet. It's trended down. Is it going to stay down? Is it going to pop back up and then go back down? Is it going to go down further? Are we going to go below 3%? How long does it stay at the rate it's at right now? Does it level off? Does employment remain steady? Does it trend down? Wages go down? Are consumers able to meet their obligations? Are corporate earnings declining? These are all the things that I think we got to keep an eye on. So when it comes to the U.S. and the economy, that's number one on my books.
We've come to the end of this podcast episode, Paul. Your insights have added a valuable layer to today's podcast discussion. Thank you so much for your time and participation. We would also like to express our deep gratitude to our CTM File audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a terrific week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.